Hello, everybody. My name is Tom Dyer. I'm the Director of Energy Procurement and Analysis here at Usource. Today we're going to cover the topics of the energy market fundamentals and provide an energy update for our large end users. Currently, the fundamentals of the marketplace that are driving the low prices, it's not often that we have a variety of items come together at the same time. And currently, we've seen four fundamental drivers of the marketplace really create the situation of having low prices. So the first is the mild weather that we've seen. Due to the El Nino that started last summer and created a slightly cooler than average summer and warmer than average winter, we ended up with having a lack of demand. And so low demand caused by lack of heating degree days is something that really has affected the market. It's led to high levels of natural gas inventory or natural gas left in the ground. On top of that, we've got a very strong shale play that continues to exist from the E&P companies that are drilling out in the Marcellus Shale, the Utica Shale, and some of the other shales. There has been a slight reduction in production due to declining prices. However, right now, we still see production that is just a whisker under last year's record levels of production. So very, very strong outlook there. Storage withdrawals are a big factor in the direction that the near-term market takes, as well as the long-term sentiment. We are currently sitting well above the 5-year averages, and we're 31.2% above year over year. So the combination of being this high, what people do, what analysts do is they look at what the balance of the winter season is looking like from a weather perspective, and they make some estimates. Right now, we're looking at estimates that could have us up 40% year over year in terms of natural gas that's left in the ground that wasn't needed for winter heating purposes. This 40% year over year translates to approximately 2.2 TCF of natural gas come the end of March. That is a very big number, and if you consider that right now the EIA is reporting the max capacity of natural gas storage capabilities is about 4.4 TCF, we very well could end up in a situation where later this year we either fill storage or get very, very close to the theoretical full capacity of storage. And so that's going to weigh on the market for the foreseeable future. This chart represents where storage prices are versus where the natural gas strip price market is. And so, as you can see, there is tight correlation between the two. So the blue line, the blue bar graph represents the storage value. So if you're looking at 2010, for instance, you see a strong storage position. And you also see a very similar pattern when it comes to the 12-month forward strip price of natural gas. When you look at 2011, you had storage that was quite a bit higher and prices that were quite a bit lower. This is purely supply and demand working itself out. At the end of 2015, because November and December were as warm as what they were, we had a very strong inventory position and prices reflected it. Since then, since the end of 2015, that position has only exacerbated itself. Natural gas production, it has begun to slow and retreat in many shale plays, and that's due to the fact that the prices are as low as what they are. So the market, with all of the technologies that they have included over the last couple of years or implemented in terms of their process to be able to extract more natural gas per well, that has it's created a situation where they've become a victim of their own success to some extent. And so with a high level of production, it created low prices. Now what we're seeing is we've had a lack of heating degree days this past winter. So we're 20% above where we were last year in terms of heating degree days. So it's a significant change, and that's contributed to the high levels of inventory and thus the low prices. We continue to see declining rig counts, which is an attempt to deal with the diminishing internal rate of return on the wells, although it's not a true solution. Capital expenditures at most of these E&P companies has been greatly slashed year over year. So, individuals or organizations that are involved with exploration and production have really made some dramatic cutbacks. there is, because of the industry, the nature of the industry of drilling, a strong potential for bankruptcies and consolidation due to the fact that these guys are highly leveraged organizations. In the event that there is an increase in interest rates, we will continue to see more bankruptcies and more consolidations because the companies will become less and less profitable. Natural gas generation is continuing to be the go-to fuel for generation. And, you know, wholesale power prices, because of that, you know, are directly affected by what's happening in the natural gas market. So what does this all mean to you as an end user, as a buyer for your organization? What we're telling folks is if your company is in a contract that expires in 2016, you should be putting yourself in a position to take advantage of this current market and make some decisions. If your contract goes through 2017 or further, you really should get a benchmark of where you're at and really hone your strategy based upon your budgetary needs. Folks who are looking at, you know, kind of playing the market, the weather patterns for the second half of 2016 could see the formation of a La Nina. That would produce hotter summer and colder winters for the next year. And that could impact prices by having prices rise because of that incremental need for natural gas during the summertime for generation purposes to meet the cooling demands, as well as natural gas for heating in the winter if it is truly colder than normal. So we've got a nice window of opportunity. Also, demand has been relatively flat. The demand has been increasing with production being relatively flat, which is creating a scenario where energy prices obviously could rise as well. So industrial production is up a little bit, and we've got flat production due to the low prices. So with that being said, I wanted to thank you for your time.